Well, hi there and welcome to this very special edition of the Greece done deal, which is going to be the key talking point all of this evening. The deal is done, but over the next 1 hour, we'll be analyzing on what this really means for the key risk which has been keeping markets on tenterhooks, which is the risk of a Grexit. Welcome to the show. I'm Tanvir in the Mumbai News Centre with Nikunj, Dalmia. And I think the talk, while the deal is done, Nikunj, will still continue on whether Greece stays on in the euro or not. That debate is still going to carry on.
That's really an academic debate from a financial market standpoint. The deal is done. Fear of a Grexit is over. I don't think there was fear of a financial Armageddon or contagion with money managers and with market watchers. But frankly, markets had run out of patience. They want Greece off the front page. And the good bit here is that Greece will be soon going off the front page. And the nuances of the deal are clearly indicating that it's not a victory for anti-austerity. This deal has a strong economic presence, and it has been done beautifully and it has been structured brilliantly.
But brokerages are circumspect about the deal and the risk of Grexit. But we'll talk about that over the next 1 hour. We have a power pack panel of global as well as local experts to join the dots and also understand the India impact of this deal that just got inked a couple of hours back. But after weeks and weeks of going back and forth, Greece and the Eurozone burned the midnight oil and reached an agreement to bail out Greece for the third time since 2010 and keep the Eurozone very much intact. The Greek Prime Minister has agreed to additional reforms in return of €86 billion bailout package.
Cyprus' plea to cut Greece's debt pile by 30% was rejected by the EU, and he will till Wednesday have time to pass the new austerity measures in the Greek parliament. This, many analysts believe, will be a tough task given Cyprus' anti-austerity stand throughout all the negotiations. But for now, Greece is still in the euro, and fears of Grexit are fast melting away. So what does this bailout mean for Greece, and just how hard will it be for Cyprus to pass reforms in the parliament? We are joined by Matthias Williams of Reuters all the way from Athens. And Matthias, what are the details of the bailout deal?
Well, the terms of the latest bailout deal are a lot tougher even than the ones that the Greek people rejected only a few days ago in a referendum. So we have cuts to pensions. The creditors want reform of labour laws. They want more spending cuts. They want VAT rises as well. And they also want €50 billion worth of Greek assets sequestered into a special fund for the creditors to supervise. The one glimmer of hope for the Greek government is that there might be some sort of promise of debt restructuring, although that would not be a debt haircut.
Right. Matthias, how tough is it going to be for Cyprus to push through these tough austerity reforms in Parliament? Because that's the next hurdle, especially since the Greek people voted a resounding no in the referendum. His own party is also divided over the debt terms.
Well, as you say, the Greek people overwhelmingly rejected calls for more austerity measures, so it will be very tough for him. There are already signs that hardliners in his own party will reject the measures out of hand. And also one very problematic thing is the speed with which he'll have to push these measures through. He only has a few days to do it, and he's still on his way back from Brussels now. The one good thing for him, though, is that the opposition parties will probably back him because they want to see an end to the drama between the Greek government and the creditors. So he'll probably be able to count on their votes to be able to get the measures through. What that means, though, for the long-term stability of the Greek government is another question.
Right, Matthias, on the one hand, there are the Eurozone leaders, on the other, the Greek people who believe that Tsipras has failed them. And he has in many ways, completely doing a U-turn on the very conditions that he got the people to vote in the referendum for. What's the likely backlash at home for Tsipras?
Well, already in Athens, we're seeing a lot of anger at the latest round of demands from the creditors. The Greek people are absolutely fed up, and they're especially comparing the demands being placed on them to making Greece into a colony. So there is going to be a lot of fallout for Tsipras. The one thing, though, is that his party, the Syriza party, is still polling very strongly. And if there were to be an election, a snap election, after these these new measures have been pushed through, Syriza would probably win it still.
Right, Matthias, thanks for that update. And so now that the Greek drama is put to rest, what implications will this new deal have on global economy? We've got a power-packed lineup for you. We've got Peter Elston, Rob Carnell of ING, Alastair of Nomura, Adam Mears of Credit Agricole, and we've got a long list from India as well, Tanvir.
Oh yes, indeed. To look at the India angle, how much of an impact will this deal have on our markets, which remember rejoiced in the session today? We'll be joined by Subir Gokarn of Brookings India, Nilesh Shah of Kotak AMC. We'll get you more perspective on what this means for India as we carry on into this week's trading.
Well, let's start with what this means for global economy. And Rob, this question is coming your way. Now that the final fine print and the nuances of the deal are out, do you think that this is clearly a victory for those who have been advocating austerity for the longest time? Because the bias of this deal is clearly economic in nature. It is not political.
Between Berlin and Paris over the nature of governance of the Eurozone, where the Germans, Berlin, are looking to create a rules-based Eurozone, where there will be strict rules which all members of the Eurozone would be expected to adhere to, whereas France, Paris, has a more laissez-faire, national sovereignty, if you like, dirigiste approach. So I think there is a good deal of politics in this, and I think that rarely for me, I rather agree with former Finance Minister Varoufakis, who said on several occasions publicly over the weekend that he felt that Greece was something of a pawn in a struggle over the future nature of the Eurozone, governance of the Eurozone between Paris and Berlin. Now, for all that, clearly there is a strong economic element to this too, which is basically not so much the austerity, but that the Greeks have got to do economic reform. They have to get their economy in order. And the German view, the North European view, is that in order to encourage the Greeks to do that, they are going to have another bailout, but there is a price to pay for that bailout.
Rob, this question is coming your way, and that's an important point that Alastair has raised, that, while an economic deal is in place, you'll have a lot of political debate still ensuing over the next few days. The parliament needs to give this deal a thumbs up in Greece, and then how the implementation of that happens, whether there is the political will and political consensus that this deal draws back home in Greece. There is a lot that Tsipras needs to face up to, given that in a way he's disappointed the people of Greece. How do you see this story playing out from here? While many are saying Brexit is off the table for now, do you think that could be a foregone conclusion, or one needs to bide time to make that call?
Oh, well, I hope you can hear me okay, because I'm going to barely pick you up from this end. But I think the interesting way in which you portrayed this as being a done deal, I think a deal has been done. I still don't think it's a done deal. We still have to get the Greek Parliament to vote and ratify this proposal. That may or may not happen, in which case you've touched on the idea with some of your other guests about what may happen in the event of there then having to be, say, snap elections. I mean, you can't kick a country out which doesn't have a government. I mean, that doesn't work. So that drags this process on still further. We've got to get the German Bundestag to pass these, and that should be less of an issue. This has the weight of the finance ministry. It has the weight of Angela Merkel behind it, but never say never. I think getting these things through is, let's suppose that this actually happens and that the Greek Parliament does vote for this, which, as I say, I think this is still an open question. Then this takes the immediate pressure off. Of course, then there can be some talk about bridge financing so that the repayment that has to be made by the 20th to the ECB can take place. That can be sorted out relatively quickly. That means the Greek banks don't go bust.
Alastair, so do you think finally Angela Merkel prevailed, Hollande prevailed, or common sense prevailed?
I think in many respects it was a high-scoring draw, except in the case of Greece, because clearly, although Greece does look likely to stay in the Eurozone for the time being, as your previous speaker was saying, It does seem that Alexis Tsipras is going home with a worse deal than he could have had 2 weeks ago. And although I think the Greek Parliament will manage to approve legislation, hopefully by close of business on Wednesday, I think the main risk in Greece today is one of serious civil unrest in a backlash against the government. I also agree with your previous speaker that we could well see early elections in Greece, and it's by no means clear that that would throw up a government which was more economically and politically competent than the present Greek government has shown itself to be to date. Now, as far as the bigger picture is concerned, I think Angela Merkel has got a lot of what she wanted, but I note today that the foreign ministers of both France and Germany actually in Vienna for these very important talks with Iran, which you shouldn't lose sight of in your news story, in many respects much more relevant to India because of its impact on the price of oil than what happens over Greece. The foreign ministers of France and Germany have declared that this was a joint Franco-German effort. Well, I think that's stretching credibility a bit, but certainly the French have got some of what they wanted as well.
Well, Alastair, I was reading a lot of brokerages reports, and it seems like, they're not so confident about the near-term risks, associated with this deal progression. In fact, they believe that, the risk of a Grexit is pretty much on the table. Still, both implementation and Greece's political landscape will remain persistent sources of risk as the year progresses. You agree?
I do agree with that. What I said was I think this will go through the Greek Parliament. The implementation is going to be much more difficult. And let's be absolutely clear about this, as I'm sure many have said on the programme already. What happens this week, assuming that things go well, is no more than approval to move ahead with negotiations on a third bailout. And that will be a fraught process as well. And we may not get there. I think it's going to be enormously difficult for the Finnish Parliament to sign up to this. And although they probably couldn't block a deal single-handed, if they were able to garner some allies around them, we might find that there is not a qualified majority in favour of the deal on the table. Now, I don't think that's going to happen, but I also don't think that we can strike out Grexit. I think in the near term, probably not. But I do think we're going to get to some very difficult inflection points downstream, if not in the next couple of months, then perhaps before the year end. And I know that my very good friend and former British government colleague, Alex White, now working for the Economist Intelligence Unit, put out a note this morning along similar lines and forecasting that Greece would not be safe until at least 2019, given its economic travails today. I don't think that that is an unfair call.
Alastair, appreciate your time and so glad you could join us. Peter Elston, good evening. Nikunj Dalmia from the Mumbai studio. Thanks for joining us. Peter, now that the deal is in place, the Eurozone and the leaders have decided to give Greece one more chance. Is it time to move on? Should global market watchers focus on data, which is what will happen to the economic growth, how much money will be printed, and what will happen to euro eventually?
Hi, Nikunj. Very nice to speak to you. Yes, I think it is probably time to move on. I suspect that there are a few more risks out there with respect to whether this deal does get approved by the various governments. But I think those risks are fairly low. And once this is out of the way, then, as you say, I think investors can focus on the what you might call the fundamentals of markets, which remain fairly positive. I think that's particularly the case for European equity markets, where you've got an economic recovery that is to a much greater extent in an earlier stage than is the case for, say, the UK or the US, where we're at a fairly advanced stage. Unemployment rates have fallen substantially from their peaks 5 years ago, whereas in Europe, the fall in unemployment only began a year or two ago and has a long way to go, meaning that monetary policy is going to remain very loose in Europe for longer, and that's great for equity markets. And you combine all that with the valuations of markets, which are still pretty decent. Dividend yields are obviously a lot lower than they were a couple of years back, but they're still above their historic averages, and that bodes quite well. So you put all of that together, and I think the outlook for European equities remains pretty positive.
It does, and remember, those markets have actually, despite all this volatility over the last 2 weeks, have been outperformers for the better part of this year compared to what the US markets have done and what emerging markets at large have delivered. Stay on with us, Peter. Lots more to talk about. But Adam, I'll come to you. How tough is it going to be for Tsipras to push through these tough austerity reforms in Parliament? Yes, the Parliament had pretty much, given its consent to the deal last Friday. But terms and conditions have become a bit more harsh. Do you think that they will still go ahead and find the adequate support they need?
That will be the key hurdle today and over the coming days, as for Alex Tsipras to actually try to reform his government after 17 members obviously abstained from voting over the weekend. Clearly a cabinet reshuffle is on the cards, and it will make it very, very difficult, even with that cabinet reshuffle, to get some of the agreed reforms today across the line. And in that being the case, there are still no guarantees that the agreement will be forthcoming by the end of the week.
Rob, this question is coming your way, and I want to take the story forward, which is, should investors and traders now do what Fed has been indicating, which is focus on data? Greece is passé. Let's focus on the ECB growth, inflation in that part of the world, and ultimately, how will that impact Europe?
Well, I think as your previous speaker was suggesting, it isn't quite off the table yet. It's not quite passé. It's still fairly much a live issue. I would give it until the end of the week and see what's happening then. But then let's suppose that the Greek issue is at least temporarily not on the front pages, but towards the middle of the financial press. Because I don't think this is the end of the story by any stretch. We'll be returning to this conditionality every 3 months, checking that the packages are being implemented properly. But yeah, let's suppose this is a middle of the financial press story rather than the front page one. Then yeah, I think you can return to the fundamentals. And again, I was listening to one of your other speakers earlier talking about the stage of the Eurozone economy and the recovery. And he was absolutely right. He's, this is an economy which is in the early stages of recovery. You've got an ECB, which really at the point that the economy started to look better, or even perhaps a couple of months previous to that, had started to undertake a very aggressive policy of quantitative easing, ostensibly designed to weaken the euro. It hasn't quite done that. It's done a little bit of euro weakening, but the economy was in any case beginning to pick up. And I think financial markets are quite rightly looking at the Eurozone and thinking, if we can get rid of some of this political garbage surrounding the whole Greece story, the macro story is actually looking quite decent, at least compared to the US and the UK, which are now realistically fairly mature recoveries. So, yeah, from an investment point of view, it begins to look quite interesting. You're going to see the inflation numbers beginning to pick up a little bit. You're going to start to see some firming and perhaps even acceleration of some of those growth figures as well. All of which, when you've got a very benign policy environment with the ECB in effect committing to keep rates at zero or slightly negative, if we're talking about the deposit rate, and carry on printing money, suggests buying Eurozone risk assets. But it's very dependent on that Greece story. So, as I say, wait and see, make sure that that's off the front pages, then it looks quite good, quite interesting.
Peter, comment on that point, the fact that this perhaps gives an opportunity to buy some of the risky assets in Eurozone. I mean, Rob has a point there because Italy, Spain, they're implementing reforms. Yes, it's not like the economy is out of the woods there, but they have done tremendous progress as far as austerity goes. And, pretty much bringing their economy back on track. Is there a sense that you have in terms of the opportunity this brings, not just for equity markets in Europe, but also for the bond markets in Europe, for Greek bonds as well? If the risk is off the table for some time, let's say 6 months, is that an opportunity window that investors can benefit from?
Well, I imagine that, you've seen quite a significant rise in peripheral market bond yields in recent weeks and months, and so if it is much more likely now that these private bondholders are going to continue to get paid, then there may well be an opportunity there. But certainly for equity markets, as I said before, the fundamentals are extremely positive. Yields are decent. The economic recovery is continuing. The scope for European companies to increase their profitability, I think, is still there. You've got returns on equity that have quite a lot of scope to rise further, which they will as the economic recovery progresses. So yes, all in all, I would be pretty positive on risky assets, whether that's equities or some of the peripheral bond markets where yields have blown out. Yes.
Let me also get some comments from Mike Ingram of BGC Partners. And Mike, let's talk about the deal impact on emerging markets. And risk and emerging markets, they have a strange love and a hate relationship. Every time when money managers, they want risk, they go to emerging markets. Every time when risk is on emerging markets, they tend to correct. Now that the Greek overhang is at least out of the way for a week or so, how do you think emerging markets will move?
Well, I think emerging markets will catch a bid on the back of it. Certainly, investors have a renewed appetite for risky assets on the back of a seeming, at least short-term, resolution of the Greek debacle. On the other hand, of course, we know that what's been going on in Greece has been factored into the FOMC's thinking. And you'd have to say that on balance, what has happened in Greece has increased the probability of a Fed rate hike in September, and certainly Janet Yellen on Friday did nothing to take that off the table. And that being the case, of course, that is something else that emerging markets is going to have to contend with. The monetary environment aside, I think that ultimately this really comes down to growth in terms of earnings growth and also economic growth. And there you'd have to say the momentum in emerging markets is still very, very poor. And of course, all eyes on China as to whether or not recent efforts to stabilize the stock market and indeed the broader economy are actually going to start to pay dividends.
Rob, in all this debate, what happens with the euro? Because that's been the bone of contention. Most analysts have said that had Greece had the liberty to manipulate its currency or let its currency adjust, if they were in an independent currency regime, things would have been a lot different. But part of the monetary union, it also lays a lot of focus on which way the euro goes from here. After the initial reaction being positive, the euro actually declined. And given the focus that there would be on perhaps the dollar trade come September, when all that talk about a possible rate hike would increase, which way do you think the bets would be placed as far as the euro goes?
A seeming resolution on Brexit actually increases risk appetite for periphery bonds. What do they do when investors buy periphery bonds? They buy the bond and they hedge out the currency, so they sell the euro perhaps forward. So that actually puts downward pressure on the currency, and this is the reason why you're seeing the price action that you've seen over recent months. So ironically, better news on Greece actually ends up translating into a weaker euro, which is something which, of course, policymakers across the Eurozone are only too happy to see.
Adam, do you think, frankly, it's time to really move on now? Is it time to really focus on other larger issues? Fed, what will happen to emerging markets, China, and will the contagion or will the meltdown in China have a contagion effect on other markets?
Yes, absolutely. In many respects, the market has already begun to look beyond Greece. Whilst the risks of a Greek exit were significant to the market, from both the nominal GDP and export contribution point of view, Greece is a very small economy within the Eurozone, and that likely explains much of markets' dismissal of this Greek crisis to date. In saying that, however, many are cognizant of the fact that a Greek exit could lead to other peripheral Eurozone economies also wishing to exit and agree to easier terms of financing, and that was the real threat for the markets. Now that that appears to have been averted, providing we get necessary parliamentary acceptance across Eurozone countries, markets will not fear that uncertainty, at least for the next 3 to 6 months.
Peter, as we wrap up this discussion, at least from, what global investors make of this development, how would you look at this deal? Would you see it as a glass half full or glass half empty? The deal done, so that's good, or the fact that it comes at a big price, a big cost for Greece, and that it could also have some political ramifications going forward. There could be a social backlash, early elections, and all of that would just delay the process of recovery for the region.
I think I'd probably see it as glass 3/4 full, in that you look around the world in terms of the basic fundamentals, and okay, they're not great. There are still a lot of challenges that the world economy faces, but on the whole, we're moving in the right direction. Growth is maybe not as robust as we'd like it to be, but it's okay, and valuations are okay. So I'd see it very much as being, as I say, glass 3/4 full, and the outlook being reasonably positive.
Peter, Rob, Mike, Alastair, as well as Adam, thanks very much for joining us, all of you, and giving us your perspective, a global view of the Greece deal getting inked, but it's not the last that we've heard so far on the issue.
Well, never say never in financial markets.
Right.
You never know what'll actually happen in the Greek parliament. And
the deal is done, but the implementation is still a question mark.
But common sense, if one has to really look at this deal, Greece is desperate for a deal right now. They have no other option, and they really have to sail and pass this deal through. So I'm hoping that the deal is done, and we will not get a retreat. We will not get a retreat in the Greek parliament. But let's take a break right now. What does deal really mean for Indian markets, and how will this change life for Indian markets, bond market, equity market? We'll be joined by a special panel right after this break. Subir, Gokarn of Broking India, Nilesh, Shah, Kotak AMC, and R. Venkatraman of IFL Group. All right, thanks for staying with us. Good day of trade for Indian markets, and Nifty honestly has come a long way from Friday's close. Was it Greece? Was it just a relief rally, or today's crack in commodities? But let's really break the importance of the Greek deal and how this will change life for Indian financial markets, all the markets, equity market, bond market, and the currency market. To dissect that and to understand this big puzzle, we have a very smart lineup: Subir, Gokarn of Broking India, Nilesh, Shah, Kotak AMC, and R. Venkatraman of IFL Group. Gentlemen, good evening to all three of you, and thank you for joining us. Dr. Gokarn, I want to start with you. How will this deal benefit or help India on the margin?
Well, I think if you accept the argument that the potential meltdown which we were looking at last Sunday with the referendum results saying that Greece was not willing to accept, or a majority of Greeks were not willing to accept the conditionalities associated with continuing the program, I don't think that had a significant impact. And so getting Greece back on track, I don't think is similarly going to have any significant impact on India. What it does do is to put, I think, perhaps it's a little bit like kicking the can down the road. First, the Greeks didn't want the terms. Now they seem to have signed on to terms that are equally, if not more, stringent than were being discussed before the referendum. So it's not very clear how the politics within Greece and in the rest of Europe are going to play out. But the thing that really matters from the Indian perspective is whether the overall financial system, the European financial system, and by extension the global financial system, was buffered from developments in Greece. And I think last Sunday's events following what happened last Sunday on Monday and Tuesday to global financial markets, clearly the buffering has been done quite successfully. Greek external debt is largely on the books of public entities like the ECB, the IMF and so on, not so much in the private sector. And that has, I think, meant that the rest of the world is relatively buffered from, protected from what's going on in Greece. So I don't think it really makes too much of a difference to India, to emerging economies in general, what's happening there. Of course, it does perhaps add a little bit of comfort to the rest of the world that the euro is now, at least immediately, not in danger of breaking up. That would have brought certain doubts and uncertainties in people's minds, which may have affected financial flows. But at least that eventuality is now certainly not with us now. It may rematerialize a few months down the road. We don't know this. But for the moment, I think things are a little calmer, and that's clearly to the good.
Venkat, all markets are correlated, and we saw how the Greece deal really brought about a relief rally across the region. The Indian market also closed at the high point of trade. So it wasn't like we were insulated in a way in terms of our market reaction from this ensuing crisis. So what's likely to be the impact of this deal from a near-term perspective on the Indian markets?
See, actually, if you put the Greece entire issue in perspective, it was quite a small event in the overall global scheme of affairs. The size of the Greece economy is very small. The problem of Greece was known to all people. And today's rally in the Indian stock markets post the resolution of Greece was just a reaction to the good news because everybody thought that Greece will walk out of euro. Now, effectively, the terms of the settlement in Greece is not clear, but effectively now it looks as if Greece will remain in the euro, and the problem has been postponed by some time. So it was just a reaction, I would say a positive reaction to the fact that Greece ultimately saw a resolution. It was not a Grexit as they put it. However, in our view, even if the Grexit had taken place, impact on India, both on terms of the stock market as well as economy, would have been a knee-jerk reaction on the day of the event. But sooner or later it would have stabilized and the markets would have recovered fast.
Nilesh, how much of today's market action in India was a function of short covering and drop in commodity prices? Because when the Greece problem was brewing up, everyone was of the view that Greece is too small to impact India. So if Greece is too small to impact India, what explains today's price surge?
Partly I can attribute you to Nikunj. You highlighted Greek problems and Greek solutions so well that probably traders become bullish on the market. But on a serious note, today's reaction is more function of the commodity prices and also the relief rally which occurred, saying that now European Union is stable. The contagion fear which some people had is not going to happen. The Italy and the Spain and the Portugal, these are also the weaker countries in the European Union, and their place in the European Union is guaranteed. More importantly, in some sense, it is also a reflection of the sound economic policies advocated by Germany and France in terms of cutting wasteful expenditure, improving tax compliance. I mean, these are all ways of improving an economy, and Greece following that steps, albeit with little bit of drama, is reflective of sound economic policies being followed in European Union. And if the whole world follows such policies, it will be beneficial for everyone. Plus, it's very difficult to read in one day's market movement what happens. Let's focus on the trend rather than just one sporadic movement here or there.
Right, Nilesh, but the point remains is, in this crisis, do you think now that a deal has been pretty much put in place, what goes on from here is more region specific, but from an India standpoint, this would make the Indian equity as well as bond market more attractive, that we would stand out a lot more within the EM pack, and if we study the European region too. So there is a stronger case to look at Indian equities, there's a stronger case to look at bonds given the credit risk profile there, and also the currency, which has been remarkably resilient?
One, what happens in our country will determine how our debt market, equity market and currency market behave over a longer period of time. In the near term, we have to look at what happens in July monsoon. It's about 35 to 40% of rainflow, and it has an impact on agriculture as well as rural economy. If July monsoon is as good as June monsoon, then definitely market will get supported across debt, equity and currency. On 26th of July, monsoon session of Parliament is beginning. The focus will be whether government will be able to pass bills like GST or land acquisition, which can push economic reforms further. Obviously, passage of those bills will be supportive to the market. The third and the most important factor for us will be the quarterly results. When December 2014 or March 2015 quarterly numbers have been below expectations, the beginning of the season is mixed. One bank's result was above expectation, one IT company's result was not so. So clearly what happens in June 15 quarterly results and what kind of guidance management gives for the rest of the year will be again supportive for our debt, equity and currency market. So my guess is that yes, what's happening globally we can't ignore. They will create short-term volatility in our market. But in the near term, monsoon, parliament session and quarterly results are going to be bigger driver for our markets than global events.
Dr. Gokarn, does this make the position of dollar even more stronger? And are you comfortable with that? Because on the margin, that actually could hurt India. Whatever is happening in Greece or whatever is happening in Eurozone, that's their problem. But their problem will have an impact on global reserve currency, which is dollar. And if dollar strengthens, it will have an impact on our exports.
Well, I think we have to be practical and realistic about why the dollar is what it is. Why is it the primary reserve currency globally? And the fact is that it is the most acceptable. Most global trade, even in between countries who do not, use the dollar, is denominated in dollars. For example, oil is denominated in dollars. Many other commodities are traded in dollars because the price setting mechanism is on US exchanges or on other exchanges that accept the dollar standard. I don't think this is going to change very soon. I don't think the euro was ever a significant threat to that particular position. So euro is, of course, itself a global reserve currency because of the European financial system's flexibility and ease of entry and exit. But the dollar remains, I think, the primary currency, and I don't think there's anything that's happening that is going to change that. There will be developments on the side. As other countries, non-dollar economies start to grow more significant, as trade between them starts to grow more significant, as investment flows start to grow more significant, you will see some shift, some rebalancing. But I think that's far into the future, and it's an ongoing process, but it's not really seriously disrupt the current currency system. Now, whether this is good or bad, I think is a matter of where you stand. From my perspective, I think it is a reality. It is something that emerges from the US's role both in the global trading system and the global financial system.
Right, Venkat, the same question that I asked Nilesh, the fact that now this event is pretty much out of the way, at least a deal is in place, will the focus now shift to other events outside of Greece? So, there's going to be more talk about what the Fed does with rates, more talk about China, more talk about local cues. What will really determine the trend for the Indian market from here?
See, as I said earlier also, Greece is a minor issue. I think the impact of Greece on Indian stock markets was over-exaggerated or over-hyped up simply because there were fears that Greece will walk out of the Eurozone. So even if Greece had walked out today, then we would have seen a knee-jerk reaction of a 1% or 2% down and the market would have recovered. And since the Greece did not exit the Eurozone, so we saw 1% up and now it will stabilize at this level. Our view is that the Indian stock markets will depend more upon Indian macroeconomic factors like earnings season, monsoon, progress on the reforms front, and those are the factors which have a bigger bearing on the Indian stock markets than Greece. So as you pointed out, I think today the market has digested it, and going ahead, any further news from the Greek front would be minor blips, but more events related to the Indian macroeconomic situation will have a bigger impact.
Nilesh, it's too naive to assume that problems in Greece will not have an impact on the currency market. Let's be real here. ECB will be forced to print more money. Euro will weaken significantly against the dollar, or dollar will strengthen significantly against the euro, which is actually bad news for Indian currency, which is also bad news for our exports. Nilesh?
I'm not an expert on currency market, but whatever I have read, I'll try to summarize. At one point of time, euro was pricing in the breakup. The fear was that Greece will exit and it will become a contagion. If that was what was priced in euro, then today what has happened will actually result into euro appreciation. And the fact is that euro did move by a big figure. It moved from 1.10 to 1.11. So probably it had priced in a break-in, and now it is getting appreciation. It is becoming stronger because the contagion is avoided. Now, if that is the scenario, then probably dollar is not going to become as strong as expressed by you. And correspondingly to that extent, we'll see our own advantages or disadvantages. More importantly, rupee has remained quite resilient in last couple of quarters. It has been one of the strongest emerging market currency. It has witnessed appreciation against yen, euro and GBP over last 1 year, last 18 months. And that has actually hurt our exports. For last 7 months, our exports are registering negative year-on-year growth. So currency market is something which can probably surprise participants by remaining resilient even when euro probably will become volatile. What we need to really focus on is our manufacturing become competitive, is our manufacturing gaining productivity, so that irrespective of currency appreciation or depreciation, our exports can increase market share in the world, our exports can increase. Today we are seeing serious limitation in terms of Indian manufacturing sector's capability and competitiveness, and currency depreciation is not the only answer to increase your export share. We need to put far more focus on increasing competitiveness of Indian economy so that we can grab more market share and not just by currency depreciation.
Fair point there, Nilesh. Dr. Gokarn, just come in on the other key global variable, which is what the Fed does with rates, because in all this talk about Greece and China, the market has shifted its focus for the last at least 3 to 4 weeks from that burning issue, which we were tracking, till mid-May, and it's going to come back on the radar. So does this push the possibility of the Fed rate hike further away, or does it mean that with the deal in place, now perhaps the Fed could take a call on rates as planned?
Again, I get back to the developments post the referendum, or the way events unfolded post the referendum. Had there been significant global financial turbulence in the wake of the Greek referendum, the results emerging the way they did, then central banks might have been compelled to put some emphasis on financial stability, and that might have then induced them to be a little more cautious on contractionary actions. But since there was no turbulence, I don't think this sequence of events will have any bearing on the Fed's timelines. It will do what it is planning to do. The way the board is visualizing the sequence, I think that is going to be basically unaffected by what has happened in Greece over the last 2 weeks, or in Europe over the last 2 weeks.
So now that everyone on this panel is of the view that Greece is important, yes, psychologically it's a booster, but it's time to look at other larger macro issues, which is rain, what will happen to rates, and of course what will happen to China. And Venkat, it's no joke that Chinese stock markets have lost nearly $3 trillion in market capitalization from the recent high. $3 trillion, to put things in perspective, is actually more than India's GDP.
See, the Chinese market, although I'm not an expert on anything to do with China remotely, especially their stock markets, whatever we have made out of the Chinese market was a classic bubble waiting to be bursted, because in the last 2 years or 18 to 24 months, the markets had more or less doubled. And given the size of the market capitalization, given the size of the trading volumes, so it was that everybody was buying Chinese shares as if there was no tomorrow. And obviously, we have seen this in other markets, other asset classes in the past, that every time you have a steep vertical rise in the market, the ending is not pleasant, and people lose their shirts on the way down. So we had the classic situation of asset prices going pump primed up, interest rates being low, a huge amount of margin trading done by the retail customers, and sooner or later laws of gravity takes over and the markets correct, and on the way down there is huge pain. Our view is that this volatility in China is good news for India, because at least the increase in MSCI weightage about China has been postponed, because I don't think you can increase weightage of a market where the powers to be suddenly ban short sales or ban you can't sell. So the poor investor, foreign investor, assuming he has shares in China, when he wants to exit, there is no exit, or you have to wait and there's a delay. So to that extent, I think there was fear 3 months ago on your channel itself that weightage of China will increase, causing to a mass exodus from India to China. Those fears have now have receded and definitely put on the back burner. So volatility in China, in one sense, is bad for the entire emerging market pack, because global asset managers might get worried about China. But China is no longer an emerging market play, because China is the world's second largest economy. Its size is huge, so I think it's unfair to club China with emerging markets. On the Indian front, I think it's positive for India, because I'm sure in this volatility some amount of asset flows would have come to India.
Sure, Dr. Gokarn, comment on the larger, impact of this deal for the Indian markets, not just from Greece, but also from the entire European Union and the Eurozone area. Could this benefit Indian exports to Europe, considering how precariously balanced we are right now, particularly engineering exports, for which the European Union is the largest destination? So, do you think that it could be a catalyst to bring in revenues, higher revenues from there for India?
Well, I think benefit in the sense that things might have been worse had Europe moved into a phase of instability, because whatever the consequences of the exit, it would have added to uncertainty, and this would have impacted on investment behavior and consumption behavior. So given that it has not happened, I think we are in a sense spared from the adverse consequences of a potential Greek exit or potential sort of fragmentation or unwinding of the euro arrangement. So if it's not happened, it means Europe is kind of back to business as usual on other issues, on its consumption, it is slowly recovering. There is obviously demand growing there. Now, so I think again we have to address the more fundamental question as to why our exports have been declining over the last several months, and that question, whether it is because of policy, whether it is because of some other global factors which we can't control, how do we get our competitiveness back on track? I think those are questions which the government has to be engaged with. But Greece in and of itself, the fact that an exit is not likely to happen, I think will add some, will provide some sort of floor, some sort of relief to our very large export, exposures in Europe. So that's a positive development.
Nilesh, let's keep Greece aside for a minute. Let's not focus on Fed. Let's only talk about India. Do you think that suddenly bulls have an edge? And the reason why, at least I feel that bulls have an edge, because monsoon is better, crude is down, and Fed will take the rate hike very, very easy now.
I don't know how to predict the short term, but definitely I agree with you that in the medium term to long term horizon, bulls have a far bigger edge over bears. One. today, if we see Chinese market, the kind of steps they have taken in terms of imposing restrictions on not selling shares beyond if you own more than 5%. I mean, even at the depth of 2008 global crisis, we never took those kind of steps. The FII investors which are looking at various emerging markets will definitely distinguish India's matured behavior vis-a-vis Chinese behavior and probably allocate more capital to a safer market like India vis-a-vis rest of the emerging markets. So this experience itself gives me confidence to say that there will be more FII flows into India compared to other peer groups. The second thing is the domestic allocation towards equity. This quarter, the domestic institutional investors have bought about 32,000 crore worth of equity. If I round that off, probably this year we'll end up seeing 1,50,000 crore worth of flows from domestic institutional investors. You multiply that over next 5 years, that number could be as high as 10 lakh crore. Now, where is the supply going to come to meet this demand? The retail ownership of Indian equity is less than 800,000 crore. The government's divestment has not crossed 30,000 crore a year, even though this year target is 69,000 crore a year. So from a domestic point of view, and there is under allocation to equity, it gives me confidence that along with FII, domestic institutional investors will also be participating in buying into equity. The third thing is related to economic fundamentals. The return on equity for India Inc. is 13% for FY 2014 and probably 11 or 12% for FY 2015. It is really at the bottom of the cycle. And from here onwards, probably there is better scope for margin expansion and improvement in ROE compared to FY 2015. The government has started spending money. Their revenue was up 30% plus in first 2 months. Their expenditure was also correspondingly up. So the spending of the government can rejuvenate the economy. The second thing will be related to improvement in liquidity and interest rate cut. When clearly 1% interest rate cut can create 7% earnings growth. The third thing will be related to improvement in capacity utilization of India Inc. So all these things gives me confidence that we will see corporate earnings recover over medium to long term.
Fair enough.
Flow wise you are better, earnings wise you are better, bulls will have an edge over bear.
Bulls will have an edge over the bears. Thanks very much, Nilesh, Venkat, as well as Dr. Gokarn, for giving us a 360-degree roundup of what this deal, this Greece deal means for the Indian economy as well as the markets. Remember, there was a bit of a relief rally that we saw in equities, a bit of relief rally that we saw in bonds, and the currency pretty much held stable. Appreciate your views as always. That's it. That's studying the India impact of the Greece deal. We've not heard the end of things there, but keep a close eye out as this risk recedes. Our markets will focus more on local cues,
which is rain, rates and earnings.
Perfect. Thanks so much for watching this special coverage.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.